Hello traders, and welcome back to Explain the Charts. Today is October 23rd, 2025, and we are doing a deep dive into gold, or XAUUSD, which has seen some absolutely massive volatility over the past week. We've hit stunning new all-time highs only to be followed by one of the steepest daily drops in recent memory. In this video, we'll cover the latest news driving this price action and then jump into the charts to identify key levels and potential scenarios. So let's get right into it. First, let's talk about the fundamental picture because it's impossible to understand the recent price action without it. The primary driver for gold's parabolic rally through September and into mid-October has been its role as a safe haven asset. Rising trade tensions between the US and China have created significant economic uncertainty, pushing investors out of riskier assets and into gold. We saw reports of the US planning tariffs up to 100% on some Chinese imports, set to take effect on November 1st, and China retaliating with their own measures. This fear-driven buying pushed trading volumes in gold futures to levels not seen since early September, confirming strong demand. However, the market sentiment took a sharp turn this week. On Monday, October 20th, gold printed a new all-time high just shy of $4,382. Then on Tuesday, the 21st, we saw a massive reversal and a price drop of over 6%, the biggest single-day decline since 2020. This crash was triggered by a combination of factors. First, President Trump softened his stance on the China deal, reassuring markets and reducing the immediate demand for safe havens. Second, a strengthening US dollar made gold more expensive for foreign buyers, adding downward pressure. And third, after such a massive run-up, a wave of profit-taking by traders was almost inevitable. Now, the market is in a consolidative phase as traders await the next major catalyst, which is the U.S. Consumer Price Index, or CPI, data scheduled for release tomorrow, Friday. This inflation data will be crucial in signaling the Federal Reserve's next move on interest rates, which directly impacts the U.S. dollar and, consequently, gold. So the fundamental stage is set for another potentially volatile move. Now let's see how these events have been reflected on the daily chart. We're zooming in here on the action from October 13th onward. You can clearly see the powerful bullish momentum leading up to the peak. Notice the massive green candle on October 16th, which saw price jump over 3.7% in a single day, breaking through the $4,200 and $4,300 levels with ease. This culminated in the all-time high of $4,381 on October 20th. But look at what happened on October 21st. This massive bearish candle completely engulfs the prior day's gains, a classic sign of a powerful reversal. The price plummeted from an open of nearly $4,360 all the way down to a low of $4,077. That's a nearly $300 drop in a single session, directly correlating with the news about the softened US-China stance. The price did find some buyers near the lows, closing at $4,092. Yesterday, on October 22nd, we saw an inside day, with the price trading entirely within the range of that massive red candle. This indicates indecision and consolidation after the huge drop. The market is essentially pausing to digest the move and wait for new information, which lines up perfectly with the anticipation of tomorrow's CPI data. Switching over to the 1-hour chart, we can analyze the recent price action in more detail. Here is the dramatic fall on October 21st. You can see the relentless selling pressure hour after hour. The price finally found a floor around the $4,077 level before bouncing. Since then, price has been consolidating in a range. The low of this range is holding around the $4,000 to $4,080 zone, which is now our immediate short-term support. On the upside, we can see resistance forming around the $4,160 level, which was tested and rejected yesterday. This consolidation is creating a classic sideways channel on the lower timeframes. Traders are now watching for a breakout from this range. A break below support at $4,077 would signal a continuation of the bearish trend. Conversely, A break above resistance at $4,161 would suggest a potential recovery is underway. News from one analyst firm highlighted a potential technical pattern, a double top. The two peaks would be the high on October 17th and the all-time high on October 20th. The break of the neckline led to the sharp fall, and their rules-based target for this pattern is around the $4,020 mark. It's interesting to note that the low from yesterday was very close to this target area, suggesting the pattern may have played out or is close to completion. Now, let's drill down to the 15-minute chart for the last 24 hours to see the current micro-level price action. This time frame is where we can see the battle between buyers and sellers in real time. We can observe the choppy, sideways movement within the consolidation range we identified on the hourly chart. Price has been bouncing between roughly $4,080 and $4,160. For intraday traders, these levels have provided clear opportunities for short-term trades. However, the decreased volume during this consolidation suggests that big players are waiting on the sidelines. A sudden spike in volume accompanying a break of this range will be a strong indicator of the market's next intended direction. Look for price action around the New York Open and after the CPI data released tomorrow for a significant increase in volatility. Until then, trading within this range carries significant risk of a sudden, news-driven breakout. Patience is key right now. Alright, let's recap the key takeaways and look ahead. The macro story is a conflict between safe haven demand from geopolitical tensions and bearish pressure from a potentially stronger dollar and profit-taking. The key event to watch is tomorrow's US CPI data. Let's summarize the critical price levels. Our major overhead resistance is the all-time high around $4,381. A more immediate resistance level is the recent high of the consolidation range around $4,160. Another key level is $4,220, which some analysts see as the neckline of the double top pattern. A failure to reclaim this level would be very bearish. On the support side, the immediate floor is the bottom of the current range, between $4,077 and $4,090. Below that, the target of the double top pattern at $4,020 is a psychologically important level. If that fails to hold, the next major support zone could be around the $3,900 area, which was a previous resistance level in early October. So, what are the potential scenarios? Let's look at the bearish case first, which I'd give a 60% probability to in the short term. The technical damage from the reversal on October 21st was severe, and the double top pattern suggests more downside. If tomorrow's inflation data comes in hotter than expected, the US dollar will likely rally, pushing gold down through the $4,077 support, likely heading towards the $4,020 target. Now for the bullish case, which I'd put at 40% probability. Gold's long-term trend is still up, and the underlying safe haven demand hasn't disappeared. If CPI data is weaker than expected, or if any negative headlines regarding the US-China trade talks emerge, we could see a rapid reversal. The first sign of strength would be a decisive break and hold above the $4,161 resistance. A move above $4,220 would invalidate the bearish pattern and open the door for a retest of the highs. Keep a close eye on these levels and be ready for volatility around the news release tomorrow. Finally, please remember that this video is for informational and educational purposes only and should not be considered financial advice. Trading involves significant risk, and you should always conduct your own research and analysis before making any investment decisions. Thanks for watching Explain the Charts, and we'll see you in the next one.